All right, and then we'll start. Okay, starting to get some people trickle in. Welcome everybody. We're going to give it just about a minute or so to let people kind of get logged into Zoom and set up, and we'll get going here in a minute. So really appreciate everybody attending. I know Matt and I were talking a little bit beforehand. Right now, it definitely seems a little more crazy than usual. So I'm sure that's driving a lot of people's interest in tonight's topic. So we're definitely going to talk about all the craziness. I'm still seeing the attendee number pick up. So we'll give it maybe 10 or so more seconds before we get going. All right. All right, so let's dive in. Thank you everybody for attending tonight's session. We're gonna give you an update on both the economy and the markets and everything that's going on. I know there's a lot to talk about. We're gonna try and keep it to around an hour with plenty of time for a Q&A session at the end of tonight's presentation by Matt. Hopefully everybody can see at the bottom of their Zoom screens, there's a Q&A button. If you'd like to pose those questions as we go through Matt's presentation, that would be very helpful. We'll hold them till the end, and then we'll make sure that everybody's questions get answered during the Q&A portion. But we don't want you to feel like you have to remember something. If you see something on, the early slides, go ahead and type it into the Q&A box. Otherwise, let me introduce Matt Potter. He is a familiar face. He likes doing these events, and we love having him. He does a really, really excellent job of connecting some of these complex market and economy topics into, scenarios and analogies that we can all understand. So without further ado, let me give his introduction. He is the Director of Investment Services, the Investment Services team at SEI. Matt is responsible for supporting the delivery of advice-driven asset management solutions for advisors like Omega Wealth Management using SEI solutions and their clients. This includes custom investment case analysis and proposal support for us advisors, as well as the technical investment support for advisors and relationship managers. Matt is also a regular speaker at events like tonight, and he has been with SEI since 2013. He has over 25 years of experience in the financial services industry. And prior to joining SEI, Matt was a principal and head of client service for Lockwell Investments, a boutique small cap investment manager. He actually was interviewed by SEI to become a manager on the SEI platform, which is always a great story to hear. Matt is a CFA charter holder and is a member of the CFA Institute and the CFA Society of Philadelphia. He received a Bachelor of Arts in Psychology from Haverford College and a Master's of Arts in Psychology from the University of Pennsylvania. So without further ado, let me turn it over to you, Matt, and feel free to take it away.
Great. Thanks, Jared. Thanks, everyone, for joining us today. I'm going to start to share my screen. And I really need to shrink down my bio so I don't force you to read so much stuff at the outset. But I guess when you've been in the industry for quite a while, things kind of add up. So hopefully everyone is able to see the cover page. I'll jump right in and as always, it's been an interesting start to the year, and we've certainly seen it's been eventful, especially in March with some of the volatility behind Silicon Valley Bank and some of the other regionals. But despite all of that, it actually wound up being, a pretty good first quarter for most asset groups. We saw stocks in positive territory, for example, especially growth stocks. And I'll talk a little bit more about this because we saw some of the performance really sort of concentrated in a few different sectors, not necessarily kind of as spread out as we sometimes see. But again, most stocks, overall, the indices were in positive territory. Something interesting too is that international equity, and we've talked a bit about U.S. versus non-U.S. stocks. If you look at I should say the dark blue bars are the first quarter through 331, and the light blue bars are the trailing 1 year period, so 331 of last year through 331. And one of the things you can see too is that what we saw in the first quarter was in many ways the mirror image of what we saw last year. A lot of what was beaten down the most last year bounced back strongly. The one exception there would be maybe commodities, which were a strong performer last year, and but fell during the first quarter, and a little bit surprising, kind of wound up in negative territory for the trailing year as well. But that is still an area that we like. But interestingly, over the past year, the best performing of these has actually been international stocks, which I wouldn't necessarily have expected. It kind of snuck in there. Now, I said that the performance of the market was maybe not kind of as broad as it sometimes is. Let me show you what I mean by that. It was a fairly narrow market, in that a lot of what did well was a few names that they're very well represented within many of the benchmarks, particularly within technology. What I show here is the top 10 names within the S&P 500. You can see the weights in this middle column. Also the Russell 1000, they're pretty similar. Both of these are benchmarks that people use to reflect US large cap stocks. And then the first quarter returns are over on the right. And you can see a couple things. If you look just at the tech names or the tech related names, they had very good first quarters. NVIDIA was up 90%, Tesla up 68. Even the laggards in that group, Alphabet, formerly known as Google, was up more than 17%. But when you leave the tech and tech related areas and go to other areas, Berkshire Hathaway was flat, ExxonMobil was flat, United Health Group was down about 10%. You really did see kind of concentrated performance within technology or technology related stocks. And this is something you can see with the index because it is so concentrated, because you have 10 names out of the S&P 500 making up about a quarter of that benchmark. A few names can really drive a lot of the performance. So if you look at it on a sector basis, again, the first quarter, you can see at the bottom what was really strong. Oh, and this is great. We have a push poll question. So please respond to this one. How are you feeling about the markets? Bullish, bearish, or meh? I like that third response, but I can't vote. Oh well. So yeah, look forward to see what everyone thinks. Given that last year was such a tough year, but then we had a pretty good fourth quarter, a pretty good first quarter. So it will be interesting. But going to sector performance, we saw strength again in technology. You can see towards the bottom, and also the areas of consumer discretionary and communication services. They're definitely related to tech. Because, for example, consumer discretionary, that has Amazon and Tesla, which are both big sector members. And also communication services has the companies that used to be known as Facebook and Google have been renamed. So tech and tech adjacent was strong. Some other areas were up a little bit, and there were some areas in negative territory, like energy, which was the big winner from last year. And some of the areas that really shined last year, the less volatile, more defensive areas, like consumer staples, like utilities, that you typically see in low volatility or managed volatility strategies. Again, they held up well last year, but in the first quarter, when markets were running, they lagged a little bit. And that's generally what you expect from some of those more defensive sectors. Now, that's just for the quarter, though. Looking longer term, we've talked about the whole idea, the contrast between value and growth, where growth stocks represent those where the earnings are growing faster than the economy or than their peers. And they're usually more expensive. Usually you have to pay up in order to get faster growing companies. And many of them are within areas like technology. Value, on the other hand, these are cheaper stocks. You're not paying as much for future earnings. They typically are concentrated in certain sectors, financials, utilities, energy, for example, but not always. You can find some value stocks within technology, for example. There just aren't quite as many of them. Value and growth tend to perform in cycles. So you'll have a period where growth is doing well, and that's when this blue line is going down. That's a period where growth is strong. And you can see back here in the 1990s through right around 2000, the dot-com era, definitely a strong period for growth, and you can see that reflected. But then things reversed. They got to around this 2 standard deviation line, and value started doing better as the line went up. Then again, reached kind of a peak here just after the global financial crisis. And then we saw growth do very well. Now, since that point, we have seen somewhat of a recovery in value. And we do think that this recovery has more room to go. We do think that when you're in an environment like we are today, where there's higher inflation, higher interest rates, it's a different environment than what we've seen over the last 10 years or so. And so it's not surprising that we would see a change in leadership. And we do think, again, when a style starts to outperform, typically it does it for a while. The pendulum swings, it doesn't usually stop in the middle, it just kind of keeps going. And so we do think that value may have the wind at its back for some time, even if it didn't succeed as much during the first quarter. And kind of along the lines of value as well is, again, the whole idea of international stocks. Here we're looking at how expensive US stocks are, which is that dark blue line, the navy blue line up here, showing a price to earnings ratio of about 18. That's basically how much you're paying for a dollar of earnings over the next 12 months. Estimated earnings, obviously, because you don't know exactly how they're going to wind up. But they're a measure of how expensive stocks are. And then if you look at developed international economies, well, they're cheaper, less than 13 times earnings. And emerging market economies, those, think Taiwan, think India, think Latin America, sort of less developed, but sometimes faster growing economies, they're selling it to PE about 12. So there's definitely, you're paying up for US stocks. They definitely are trading at a premium. And that's not always the case. Certainly back in 2010, they were much closer to each other. But then we had a long period where, number one, growth and technology were doing well, and the US indexes tend to have more exposure in growth and technology. So when that sector does well, it helps the US look better than other geographies. Also, we had a period where the dollar was strong, and that's something that also helps US stocks relative to international stocks. But again, both of those are kind of cyclical phenomena. They don't, there's no law that says that the US will always outperform. And again, if we are in a period where growth maybe fades a bit, where value does a bit better, or where the dollar kind of weakens or goes sideways, that again could turn into a good period for international stocks. We do think they look compelling from a valuation point of view. Certainly there is some negative news that's priced in, and some of that is reasonable. I mean, the situation in Ukraine, for example, has had much more of an impact on Europe than within the US, particularly things like natural gas supplies. But even given that, I think a lot of that seems to have already been priced in to valuations. So we do think it's important to stay diversified. That can mean owning large companies and small ones. It can mean owning US stocks and non-US stocks. And it also means owning stocks and bonds. Again, that's usually the best course of action because trends can change, and you never know when one asset class is going to outperform another. You don't necessarily want to be overly concentrated in one particular area. I mentioned bonds. Let me turn to those now. And, last year, and I think I talked about this the last time we met, last year was a very tough year for bonds, a surprisingly difficult year. And I say that because last year bonds were down about 13% for one index. Other ones obviously can behave a little differently, but certainly more so than we have seen in a long time, if ever. Last year was one of those rare years where both stocks and bonds were in negative territory. And as I mentioned before, that's only happened 3 times since 1926. So it's extremely rare. Now, the good news with that is because it's very atypical, hopefully that means it isn't going to be happening again for a while. And hopefully that means that going forward, bonds can start to play their role again, giving more stability to a portfolio, helping bring down a portfolio's volatility, because typically bonds will do well or better when stocks come under pressure. And you can see that the first quarter was, pretty good period for bonds. They were generally up across the board. Again, they don't always perform the same because some of the risks in these different types of fixed income instruments can differ. But for the most part, it was a pretty positive environment for bonds. So a welcome change after a tough year last year. This chart on the right, I think, really helps to show just how dramatic a year last year was. I've talked about the yield curve before. This is what we're showing. So if you think of a bond as an IOU, you're lending money, in this case, to the US Treasury, but it could also be lending it to a municipality or a corporation or a mortgage holder. But in this case, if you're lending money to the US Treasury, what the chart shows is essentially how long are you lending it? So are you tying it up for 1 month, 3 months, 2 years, 30 years? And then while the bond while the Treasury has your money before they pay it back, what rate of interest are you going to be getting on your funds? Typically, you would think that the longer you tie up your money, the more interest you would demand in order to compensate you for that. And normally that's the case. And that really was the line here at the bottom, where the further out you go with your bonds, and this is just the time until the bonds mature or the time until the money that you lent to the Treasury until you get it back. And it also reflects what the yield is. Again, what are you getting paid in terms of semi-annual dividend pay or interest payments on your bonds? Now, this is a normal upward sloping yield curve, and this is what it looked like a year ago. But things really changed. And you can see a couple of things. One, interest rates really across the board went up. Interest rates are conversely related to bond prices. If yields go up, if rates go up, then prices go down. And you can see this is a big move within the fixed income space. A move from very close to zero interest rates up to north of 4%. The Federal Reserve essentially put through about 2 years of interest rate increases in maybe a 14-month period. They were behind the curve in terms of fighting inflation. They really needed to be aggressive in terms of addressing it. And the way they do that is raising interest rates to try to slow the economy, to try to bring down inflation. It's somewhat of a blunt instrument, but it's the main one that they have. And so this part of the yield curve towards the left, very short-term bonds, this is what the Fed controls more directly. And again, you can see they brought rates way up. Now, as you go further out the yield curve, market forces tend to have more of an impact on bond prices. So you'll see expectations for economic growth and for inflation kind of get baked in here as well. And you can see the shape of the yield curve now is very different from what it was before. It's not going up and to the right, it's actually going down to the right. This is an inverted yield curve, and it has been inverted where the shorter end of the yield curve, the bonds that are maturing sooner, are actually paying higher interest than the ones that are maturing later. That's not typical. And in the past, that has been a predictor of recession. So if past is prologue, and as I'll mention in a couple of slides, we do think that certainly the odds of a recession have gone up. This is kind of the bond market's way of signaling caution, signaling some maybe pessimism about economic growth as we look forward. So it's an important thing to watch and to be aware of. But the other thing here is that interest rates now are much higher than they were a year ago. And while that was painful last year, while that adjustment took place, if you're going into the bond market now, you're getting a better interest rate than you were before. And this has made bonds more attractive. And there's been, I think, renewed interest in bonds. You don't have to take on a lot of duration risk. In other words, you don't have to have a bond that's going to be, tied up for a long time until it matures. And you don't have to necessarily take a lot of credit risk. You can buy a treasury, you can buy a high quality corporate bond and still get a pretty nice yield. And typically, most of the time, the performance you get from your bonds is going to be determined by the interest that they pay, the coupons, as opposed to changes in their principal value. So while last year was kind of a painful reset, if rates stay a little more stable now, that could mean good things for bonds going forward, or at very least that they should be less volatile than they were last year, because now you're getting compensated with some degree of interest, even if there is some fluctuation in the principal value. We do think that bonds are going to return to their historic role of being able to diversify portfolios. And so we do think that they still do make sense to have within a portfolio, because last year what we saw, again, highly unusual environment, but we think not one that is likely to repeat itself anytime soon. Now, I have a couple slides where I talk a bit about our outlook. So this one, a little bit kind of we show, what positive things can you look at? What negative things can you look at? Because there are always things that you can get enthusiastic about, and there are always things to worry about. We try to really kind of survey the world, see what the data is telling us, but we do like to kind of talk about what's going on in this way, because especially right now, there is some murkiness about where things are headed. Many of the issues that markets are facing now are actually pretty similar to what we saw last year, although the first one is probably the biggest exception. And markets don't like uncertainty. And so until we get to the point where they are resolved, we may be in a bit more of a trading range as the markets kind of try to figure out their direction, try to kind of find their footing. So for example, the year started off pretty strong. We had a very strong January, and up until we saw the issues with Silicon Valley Bank in early March, economic growth looked pretty good, but also inflation was a bit higher than expected. However, once that happened, we do think there was a significant change in terms of the overall banking system. And we're seeing the results of our poll. This is interesting. So most people put down meh as the response. I can't blame you at all. No one bearish, a couple of people bullish. And yeah, meh actually might not be a bad way to characterize the market right now. Because again, some of the issues that happened with Silicon Valley Bank, they weren't necessarily indicative of major systemic risks. We do not see this as being a repeat of the global financial crisis. That's the good news. The problems at a small number of regional banks were pretty specific, and they were pretty obvious. Really just kind of a mismatch between assets and liabilities, which sort of forced the bank to sell things they didn't want to sell sooner than they had to at a discount. And ultimately, because of that, regulators were able to come in quickly and help the system, both the banks that particularly needed help and also making credit more available to other banks. So again, different kind of environment than the global financial crisis. But it is going to have some consequences, we think. One of the things that it could result in is less credit availability, tightening lending standards. Because I think a lot of banks looked at what happened with Silicon Valley Bank, with others, and really said, that's a risk we don't want to take. We really need to, tighten things up. We need to become more selective about who we're going to lend out to, and we need to maybe keep more capital on our own balance sheet. And so if there's less lending, if there's less availability of credit, that certainly could have a slowing impact on the economy. We've also started to see, and I think this is just exacerbating this, where a lot of depositors, especially those who have more than $250,000, because the FDIC insures the first $250,000 in a bank account, but beyond that, those assets aren't insured. And so you saw a lot of people with higher assets move some or all of those assets into either a money market fund to get a higher rate of interest, or a larger bank, one of the really major players, as opposed to a small regional one. And that is challenging for a lot of the regional players, because again, if they have less money in terms of deposits, that's less money for them to invest or to lend out. And that, again, also likely is going to have more of a tightening impact on overall credit. Regional banks are very important. They contribute, they account for maybe 2/3 to 3/4 of the real estate loans that are out there in the country. And it's very important that they maintain their fiscal health. And I think that's one of the reasons why you saw not just regulators, but also companies from private industry come in to help some of these banks. And so some degree of challenge with these banks, again, could have more of an impact on the overall economy. I talked a little bit before about the Federal Reserve. Again, they've been raising rates, and so have other central banks too, in Europe, elsewhere, even in Japan. And again, all really trying to do that to fight off inflation. Now, the good news is we think they're getting towards the end of their cycle. The Federal Reserve probably is close. We think they may have a little bit more to go, maybe one more rate hike, hard to say. But some of the issues that happened in the regional bank space, if there is a tightening of credit, that actually can substitute for one of those or two of those rate hikes. So that may actually have done some of the Fed's work for them. So again, at some point, the Fed will be done. And I think that is certainly something that's going to be greeted as a positive for markets. But then the question is going to be, okay, what happens after that? Do they stay, do they keep rates at higher levels, or do they start to cut rates, which typically will help stimulate the economy? We have a difference of opinion with the market right now. The market seems to think that the Fed, by the time we get to year end, is likely to cut rates from here 2, maybe 3, maybe even 4 times. We don't think that's going to happen. We believe the Fed, once they get to that final rate hike, they're going to keep rates at that higher level. Because inflation has been more stubborn than people have expected. Certainly, we've seen some improvement there. We've seen improvement in, energy prices, in goods prices. The supply chain issues certainly have improved. But one component of inflation that still has been pretty high, it's for a good reason. It's wage increases. The unemployment situation, the labor situation is such that you have maybe something like 1.8 job openings for every unemployed American, and the unemployment rate is quite low. So because of that, workers have more of an ability to negotiate higher wages, and that is something that we think is likely to keep inflation higher than what the market thinks. And if inflation stays higher than expectations, then the Fed will have to keep rates high again in order to counteract it. And even if the economy slows a lot or we go into a recession, we still don't think that would be enough to bring inflation all the way down to the target level that the Federal Reserve has talked about, 2% for a particular index that they look at. And we don't think it's going to get there. Even if it does get close to it, we don't think it's going to stay there for very long, certainly not over a full economic cycle. And there are some longer term pressures that we think may keep inflation higher than what we've gotten used to. We had an environment where since the global financial crisis, where interest rates were essentially zero, the cost of capital was very little, and inflation was quite low. And that is, again, very atypical. And it doesn't usually stay that way for long. And so I think in some ways we may be kind of getting back to more normal historical levels, but they feel much higher because we've gotten used to levels being so low. Now, with all of that, that's going to have implications for stocks for a few reasons, because generally, most of the time over the long run, stock prices are driven by corporate earnings. Sometimes it's for more temporary reasons. We think some of what we saw in the first quarter may have been for more temporary reasons, a bit of a bounce back from last year's strength. Also, with the issues with Silicon Valley Bank, there was a drop in interest rates. That's something that may have temporarily helped out equity markets. But really, the markets have been going in kind of an up and down pattern this year, and we wouldn't be surprised if that were something that continued. So far this year, we've had, if you just look at the S&P 500, it went up about 9%, and then it went down about 7.5%, and then it went up about another 8%. And had a little bit of a tough day today, so we don't know where it's going to be heading, but it hasn't been kind of a smooth line up. It's been a little bit more jagged. And when you have issues coming over from last year that, again, haven't yet been resolved, then markets are trying to make decisions based on just incomplete information. So, when's the Fed going to stop? What's going to happen ultimately with inflation? What impact will this have on corporate earnings? What's going to happen in Ukraine? What's going to be the carryover effect of China's reopening? All of these are still kind of being resolved. So we could see a market where, there may be some good news that comes out, and investors get very enthusiastic, and then there might be some bad news that comes out, and they just become more pessimistic. We think we may be in a trading range for a little while because of that, until markets can kind of sort out where things are going when there is a really clear trend. And at this point, we haven't yet seen one. So my last prepared slide before we take questions is this one, kind of trying to put everything together and how we're positioning. As I mentioned, some of what happened in particularly with regional banks, we think have raised the odds of a recession, that it might not start until next year. And, we could even get an economic slowdown that doesn't quite meet the definition of a recession. There is kind of a qualitative element to it. But even if it's not a recession, we do think there's going to be a slowing of the economy, and probably going to have an impact on corporate earnings. Also, as I mentioned, we think inflation is going to stay higher for longer than people expect. And certainly, again, even if there is a recession, that's not going to be enough to bring inflation kind of all the way down to where the Fed wants it to be. So given all these things, we're a little bit cautious right now with respect to the stock market. Stocks, generally speaking, some of the impacts of some of the things that I've talked about, they're probably going to be spreading through different sectors at different times. They've started to hit areas like housing, and certainly that makes sense. When mortgage rates go up very quickly, that's going to have a pretty big impact. And they may be, kind of broadening into other areas. You may have this kind of rolling recession where one industry gets hit, and then another one, and then another one. It may not be that everything slows at the same time, but things kind of slow in stages. And now the good news is we don't have to own inactive strategies. You don't have to own every stock. You don't have to own all of the benchmarks that are out there. You can really pick and choose what parts of the market you want to concentrate on. As I mentioned, value is an area that we think it looks attractive right now. If things are uncertain, then maybe paying less for stocks, having a little bit more of that downside cushion, and being in areas that may be more likely to benefit from the current environment, we think may give you more of an advantage. So that's one thing that we have been doing, focusing on value, and in our more conservative portfolios, focusing on more defensive, more stable types of companies and stocks. And that has also, I think, true of bonds, where to some degree we have been a little bit more defensive there too. Now, getting defensive in bonds can mean essentially each bond carries a different type of risk. And sometimes if you shift away from one type of risk to another, that's something that can actually improve your overall portfolio. So areas that we like, some of these securitized areas, bonds that are backed by tangible assets, asset-backed or mortgage-backed bonds, for example, we think that gives you an upgrade in credit quality versus, say, below investment grade corporates. So we think you're still able to get some good yields from the environment, but maybe doing it with less credit risk. And one area that we like, which is a little bit outside of these, is commodities. Depends on which strategy of ours you're invested in, but in a number of our strategies, we have either direct investments or investments in sort of proxies of commodities, because that's an area we think, even while last year was a strong year, China's reopening, we think really is going to mean positive things for emerging Asia as well as China. They're big users of a lot of raw materials. And we had a long period where commodity prices were low and a lot of commodity producers really just didn't invest much. They didn't have the capital to do it, and it wasn't kind of worth their while. So they need to do some catching up. And if we do start to see some reinvestment in these sectors, kind of making up for lost time, that's another factor that we think could be favorable for commodities overall. And that's not to say that we have 50 or 60% position in commodities, nothing like that. Again, we always want to have diversified portfolios, but we think having assets that can do well in a more inflationary environment, we think makes sense at this point. And commodities are one such asset. So with that, happy to start taking questions, and I am going to start to flip through the slides that our good friends in legal and compliance always encourage me to show, very more than encourage. So as I work through these, Jared, happy to see if there are any questions either that you've been getting from clients or that clients have for us right now.
Yeah, we got a good one come in from one of our clients. He's asking, how does COVID and government spending make the conventional predictors, things like the yield curve inverting? What is the impact that some of those things have on those, conventional predictors of market performance, recessions, those kind of things?
Yeah, that's a good question, because COVID, um, the aftermath of it, and I think importantly the response to it, certainly has had a pretty big impact, and I think really made conditions very unusual. We saw, for example, the Federal Reserve again bring interest rates way down. Again, they had done that. They put in an extraordinary amount of stimulus after the global financial crisis, and so when 2020 came, when COVID hit and the economy just pretty much slowed, ground to a halt, they re-upped that and did even more. So you had the Federal Reserve bringing interest rates down. You had Congress approving a lot of spending. There was much more stimulus put into the economy than you typically see. It was kind of an emergency situation. Now with that, think if you're not going into the office, you're now working from home. You now have maybe some additional funds that you've gotten, from the government, or you're spending less. You're not traveling. You're not doing quite as much. You're going to start buying a lot more stuff. And we certainly saw this. We saw the trucks all over the place, packages, and and that really was one of the things that led to the supply chain issues, because so many things needed to be, so many things were being manufactured, for example, in China, but China was dealing with COVID too. So it was harder for them to do it. So prices went up, and there were really backlogs in terms of getting items to their end consumers. So rates were kept artificially low for a long time, probably too long. You might not hear the Federal Reserve necessarily admit it, but I think they kept rates low. They weren't seeing inflation happening because usually that's what you expect to see. it finally did come in, and I think it caught them off guard. So whenever you're talking about something coming from an artificially lowered point, you're going to see some unusual trends. If you're coming off of zero and kind of resetting, that's a big move, even if you're kind of just getting back to normal. So in some ways, again, the economy has sort of been going back to where it should have been, or where it would have been without a lot of government stimulus, and without the Federal Reserve kind of keeping rates lower than they should be. And that, I think, really has, again, caused some turmoil and caused some volatility. You can make the argument, well, what does an inverted yield curve mean? What does it predict? With rates as close to zero, maybe things have been distorted a little bit. And with the Federal Reserve, they were actually buying treasuries to kind of bring down the other parts of the yield curve that normally trade. If they hadn't been doing that, maybe rates would have been higher and maybe the curve wouldn't have been inverted. Certainly, it's reasonable to ask the questions, what other factors may have been affecting them? Because if you have something that is being kind of artificially tinkered with, or something along those lines, it may not be as good a predictor. Again, we do think that given what's happening this year, there probably is a higher chance of a recession, but it's not necessarily a done deal. It could be a situation where there's a slowdown, but not a recession, which again would give the yield curve the brand of kind of a false signal. We're not going to know for a while, but it is certainly possible that it could, although some of the most dangerous words in investing are, it's different this time, but there is at least a possibility that it could be a little different because some of the conditions were so different.
Yeah. So am I hearing you right? SEI is not in the camp calling that there will absolutely be a recession?
We think the odds have increased. We don't think it's necessarily a done deal, though. It's probably more than a 50% probability, but it's difficult to say that it absolutely will occur. We could, and one of the things is, in some ways, it may be a distinction without a difference. You can have an economy that slows, corporate earnings that go down, and still not be declared a recession by the National Bureau of Economic Research, which makes that call, because they look at a lot of things, including labor markets. And if the job environment still stays strong, but everything else weakens, that would be unusual, but it could happen. And so they might say, well, yeah, these parts look like a recession, but with the job market this strong, it's not. So we could get something that feels like, acts like, walks and quacks like a recession, but doesn't necessarily get called one. So that may be the more likely scenario.
Yeah. So I've read a lot recently about how we may be entering a new phase in investing. If you look at like the 1980s to the 2020s, globalization, COVID kind of marked, some people are positing and into that, and globalization is shifting. We're certainly seeing rising tensions with China and the US. Mm-hmm. How does SEI view what lies ahead kind of with the geopolitical risks and things of that nature?
Yeah, I think, especially with respect to China, it's interesting because certainly the rhetoric has been a lot more negative for some time, but there still are important trading relationships. And, China really does want to reaccelerate their economy from where they were during COVID. That's why they reopened just so dramatically. They pivoted completely. And they're probably not going to get there just by staying domestic or just trading with a few weaker economy partners, Russia, for example. They are going to still need to trade with the rest of the world. Look at, Europe, for example. We were talking earlier, high net worth Chinese consumers are an important end market for a lot of European luxury goods. Even if there is some degree of companies, say, onshoring, bringing some of their production back onshore, or friendshoring. For example, if you're a US manufacturer, maybe, instead of having something manufactured in China, you have it manufactured in Mexico because it's closer, easier to transport. Even if there's some degree of that, it isn't necessarily that doesn't necessarily mean the end of globalization. Certainly, economies have become much more, I think they're more inherently globalized, and trade has become much easier. And the ability to, manufacture, take raw materials from one area, produce component parts somewhere else, manufacture finished goods somewhere else, that has become much easier. So it certainly will have some degree of impact. It could mean that corporations have to spend more on their whole supply chain. But if it if it becomes more profitable for companies to go back to that model, they certainly will. I mean, it is, and it is something that even China may look at ways that they could improve their supply chain resiliency. But our world is too interconnected right now to think that it's going to go back to being as siloed as it used to be. It may go a little bit back in that direction, but we don't think it's going to get back there entirely. Certainly not from where we are today.
Yeah. Great. So we were talking about this before we started the webinar. I just got another question about it come in, and I was in a client meeting earlier today and it came up. So let's talk about the debt ceiling.
Yes.
Yeah. So I guess we were kind of thinking it's not a 0% risk, right? There is some risk. It may be small, but what is the thinking on that front? Is it possible? What happens if we default on our debt and the implications afterwards?
Yeah, and again, that's one more piece of uncertainty that markets don't like contemplating. Back in 2011, when things got they came up to the midnight hour close enough that rating agencies began to take a look at the U.S. and say, this is not a good thing. It may affect your ability to service your debt. Now, since that point, people are still borrowing from us. The U.S. dollar still is the de facto world currency, and so that certainly helps. But and you're right, we do think that this ultimately is political theater, that there is posturing going on. It is more of a performance art, for lack of a better word. And but I think everyone does know, or I won't say everyone, enough people know the catastrophic implications of defaulting, that we don't think that it's going to happen. There may be some individuals who don't understand how the economy works, but who are still in a position of power, or who don't care and are willing to crash everything. We don't think there are enough of them, though, to actually make it happen. And even if, say, you got to a situation where that was about to occur, there may be extraordinary measures that the administration could take, the Treasury could take. There's certainly been discussions about things, producing a $3 trillion platinum coin and putting it in a really safe place, or something along those lines. Maybe it's something like that, or maybe there may be other creative ways to prevent this from happening. But it certainly isn't helpful, because if there's any doubt about our ability or willingness to pay back our debts, and that's going to mean higher interest rates. That's going to mean people will be less likely to lend to us or demand higher rates than before. That's going to mean higher rates for everyone on everything. It's also going to mean we're paying more on our national debt. None of that accrues to our benefit. So I think there are enough people, and there are enough lobbyists. This may be a time when lobbyists actually are seen in a positive light, because if you have enough people from major financial institutions, for example, talking to their favorite senators or Congress people in very stark terms about what must happen, hopefully enough arm twisting can help there. So, we don't think that a default ultimately will happen. But again, it doesn't necessarily have to, like we saw in 2011, to at least introduce some level of uncertainty. And that could be another one of those factors that kind of keeps us in a trading range where, if there's some uncertainty, people worry, and maybe there's some weakness in stocks until it gets resolved. But yes, so again, yes, there is some tiny probability, but we think it's so small, we just don't see it as a very likely outcome.
So is it fair to say that we should expect volatility? I don't know when the exact date. I think it's sometime in June.
Yeah.
Increased volatility as we go into June if it's left unresolved, but we should not necessarily be repositioning portfolios, investment strategies with the debt limit in mind. Is that fair to say?
Yeah, that's how we would look at it. Yeah, it is, again, it is a source of uncertainty. We think ultimately it gets taken care of because it has to, but it is entirely possible that if it's discussed more, as it gets more attention, that it may have a temporary negative impact.
Right, right. Another question came in about layoffs, and this is, I guess, what I don't know. I'd like to hear your take. It seems like we've been super hyper focused on inflation reporting day, and as we've seen the inflation numbers tick steadily down, I'm starting to notice more focus around the unemployment numbers. That feels like a bigger driver of headline risk these days. We've seen some companies announce big layoffs, particularly in the tech sector. The client that poses this question, I saw a similar article talking about large companies offering new hires, like McKinsey and Company is offering new MBA graduates positions, but they're paying them like $40,000 or $30,000 to go on Safari or learn a second language. How does all of that impact the markets and increasing the odds of a recession?
Yeah, it is, even with, and I think you're right, because some of those have been headlines that have come from a few industries as opposed to across the board. There still is a lot of demand for workers, and again, the unemployment rate still is extremely low. When you look at the number of people, I won't name companies, but there are some massive companies that even if they announce large sounding layoffs, it's a tiny, tiny percentage of their overall global workforce. And a lot of these companies overhired. They built up too much capacity during during COVID, during and after COVID, and they now have too many people. So some companies need to do that. There also is a little bit of a herding effect. Within an industry, if one company starts to lay off, CEOs, they will look to their peers and say, well, if they're laying off people, then maybe we should be doing it too. I mean, there really is some amount of that type of it can impact things. But again, we haven't seen anything really widespread. I think it's important to sort of look at what are interesting anecdotes as opposed to what are really big broad trends, and we haven't really seen any of those trends. And we are seeing a situation too where you look at the demographics. More baby boomers retiring, fewer people in their kind of prime working years. Now there is another big generation coming up after that, but we'll have a period where again the demand, just trying to get enough people, companies I think still are going to have more of a challenge of hiring people. One thing that could mean is companies are going to have to emphasize things like robotics or AI in order to fill some of those voids. And that could have an impact on corporate expenses, which it's one more factor that overall could result in a little bit of a slowdown. But again, it would take a lot to really strike the labor market down, to really seriously weaken it, even if we are seeing some some headlines like that.
Yeah. Well, and I think we saw one of those companies, I know you didn't name any names, where we saw Facebook, Meta lay off, thousands of employees. And then I think as a result, their stock did pretty well the following quarter. So there may be some new focus on efficiency. Who knows?
Yeah, exactly.
So I think that's all the questions that we had come in. I don't know if I have any other questions. Any last thoughts from you, Matt?
I guess what I would say is, it's always important to take a longer term perspective. I mean, it's very, there's so much information coming at us. And we're so trained to look at what happened last quarter or in a kind of short period of time. But, I always like to remind people, we're human beings. We are not wired to be good investors. We're usually actually wired to do the wrong thing at the wrong time. And so I think, having a plan, having guidance, having, ideas, don't let a short-term event cause you to change a long-term decision. I think it's important before you do anything drastic with your portfolios. For example, look at what your longer-term goals are, look at your current situation, look at everything, and really make sure that what you're doing is well thought out. Because it is, when left to their own devices, people will very often do the wrong thing at exactly the wrong time. And I include myself in that category too. So I think it's always a good idea, get a second or third opinion, and really don't look to make any major changes, until you've really had a lot of good discussions and looked kind of at everything.
Yep. I love that is the wrapping up point for you. That's certainly our philosophy, and we hope to be those accountability partners for our clients. I think I just wrapped up writing our first quarter market commentary, so keep an eye out for the newsletter coming out in a couple of weeks. I threw in a nice quote from John F. Kennedy. He always says, the time to repair the roof is when the sun is shining. So if we're having conversations about repairing your portfolio when it's raining outside, that's not the time to be doing it. So we're always curious to hear about clients' cash needs. That's a particular interest of ours. We want to make sure those are well protected. And that's our primary focus for our clients, relying on their portfolio. Otherwise, it could be a buying opportunity, right? So let's end things there. Thank you again, Matt. We appreciate it as always. You coming.
My pleasure.
To give these talks. It's very insightful, and we hear from our clients, they love it too. So thank you from everyone.
Absolutely. Happy to do it.
All right. We've been recording, so you probably got a little notice at the beginning if you're attending this live that this has been recorded. Otherwise, we're going to be posting this in the coming days. And can we get the slides? Can we make those available?
I will do that. Yes.
Yeah. Thank you. All right, everyone. Have a great evening, and we'll hear from everybody soon. Bye.